All right, let's introduce our guest host this morning. He's Peter Churchhouse, the Managing Director at Morgan Stanley Dean Witter. He joins us this morning from our studios in Hong Kong. Peter, good to have you on the show this morning. What do you make of what's happening with the Asian markets? It seems like all the markets are following the direction of what happens on Wall Street.
Very much so. I think there are a couple of things really that I think people are focusing on in Asia. Generally, first, I think many of the economic numbers around the region have probably peaked out in the first flush of recovery that we've seen in the Asian crisis. And secondly, I think markets are focusing on the fact that the major central banks around the world are now embarking on a tightening monetary policy, which means money is going to get more expensive in this part of the world as well. And I think that's a key focus. And following, I think people here are watching the Fed very, very closely, and that's having a big impact on markets such as Singapore and Hong Kong.
What's your favorite market?
Really, our favorite markets in the region right now are markets such as Malaysia. We still like Taiwan a great deal.
Well, all the MSCI news is in already.
Well, that's not the issue. I think really the Malaysian economy is actually growing very, very rapidly, still coming out of the recession very sharply. We've still got an undervalued currency. We've got exports and the trade surpluses running now at about 24% of GDP. These are very, very good numbers indeed. The main concern we've got there, however, though, is that we do expect to see monetary policy tightening in Malaysia going forward, and it is quite clear that we have seen a capital flight from Malaysia. So all these great earnings and so on are not being plowed back into the economy in investment terms. So that's the concern, but at the moment it looks very, very powerful indeed.
What would you be owning in Malaysia?
Well, at this point, we're still quite comfortable being involved with the principal banks. We're seeing a very strong restructuring story there in the banks in Malaysia. Maybank and Public Bank in particular we're focused on at this stage. And on a more conservative note, the power companies, Tenaga Nasional, there's a company that will benefit very strongly from this economic recovery that we're seeing.
Where do you see the KLSE composite at the end of the year?
Well, we're still fairly positive over the course of the next few months. We would think that we could see another 10 or 15% upside probably over the course of that period. But I think we do have to look further out at further monetary tightening beyond that period.
What about some of the other Southeast Asian markets? Are you equally as bullish about markets, for example, in Thailand and Singapore?
We're a little bit concerned about Singapore near term. We do expect to see further interest rate tightening in Singapore. However, the market has been hit pretty hard recently. So we're basically getting to the point where perhaps the worst is over. We're closer to the bottom of the cycle in Singapore than we are at the top. And in terms of our valuation models for that market, we're probably not too far away from actually putting a buy recommendation on that market. As far as other markets such as Indonesia and Thailand are concerned, these markets are now becoming almost increasingly irrelevant to most big institutional investors. The markets now are very small in terms of their total market capitalization, and the trading volumes that you're seeing on these markets are again very, very low indeed relative to the big North Asian markets, which are going much, much stronger. We're seeing much higher volumes, much bigger companies, bigger market capitalizations and so on. So for index-weighted funds, markets such as Thailand and Indonesia are now a very, very small part of these indices.
Okay, Peter, thanks for that. We're going to come back to you in a few more minutes and talk a little bit more about some of the things that you just brought up. Peter Churchhouse, Morgan Stanley Dean Witter, will be joining us once again in a moment. All right, let's go back to our guest earlier, Peter Churchhouse of Morgan Stanley Dean Witter. Peter, what are your thoughts on investing in the Hong Kong market? There are thoughts and expectations that perhaps the Fed's tightening cycle is nearing an end, and perhaps Hong Kong is seeing a 5% rally yesterday. Investors can expect more gains from that market?
Well, that's right. I think we're probably closer to the end of the Fed tightening cycle than the beginning, and as a result, I think we'll be looking, I think, to take another look at Hong Kong in a couple of months' time in terms of increasing weightings. At this stage, though, we're expecting another 50 basis points from the Fed, and that will get translated into higher interest rates here in Hong Kong. And this market is a very interest-sensitive market, so I think we've got a little bit of choppiness ahead of us over the course of the coming few months. But by year-end or somewhere around the end of the third quarter, beginning of the fourth quarter, we're expecting to see an expectation that the Fed will be moving more to maybe an easing bias than a tightening bias before year-end. that will be a major signal to come back into markets like Hong Kong and Singapore.
The interest rate sensitivity in our market would be a signal for a lot of fund managers to get the hell out of this market before more rate increases come through the pipeline.
Well, we've had a pretty big fall from our highs of over 18,000 that we saw a couple of months ago. Many of the interest-sensitive stocks now are plunging into areas where they're really at the low end of their long-term valuations. We're looking at a lot of the major property stocks at the moment, for example, trading at discounts of up to 70% to their net asset value. These stocks are too cheap. They're not going to stay there forever. I'm not saying today is the day to buy them, but I think over the course of the next couple of months, some of these names are going to become very attractive indeed. And we're starting to see some of the bigger fund managers, the big institutions, starting to sniff around some of these names at this stage, because when they want to come into these names, they invest big and they invest in big size, and they can't get into these stocks very quickly. So they'll take them if they think they're fairly close to the bottom of a cycle.
Why do you think the Fed is going to go from a tightening bias to an easing bias by the end of the year? Why would they want to lower rates just when the economy is starting to slow?
Well, that's the whole point. The economy is starting to slow. We've seen the peak of the U.S. Growth cycle in terms of GDP numbers, but it normally takes a few months, up to 6 to 12 months after the peak of the GDP cycle, to expect to see the inflation starting to cool down. Inflation numbers are still relatively strong at the moment, and I don't expect to see those easing off until we get towards the end of the year. So until that starts to happen, I think the Fed will still maintain its tightening bias. But that's probably 4 to 5, maybe 6 months away. So what we're trying to anticipate is what's going to happen towards the end of the year. We're pretty comfortable with what we're going to see over the course of the next few months, which is another 50 basis points from the Fed. But beyond that is what we've really got to look for.
Which among the development counters, the property developers, do you like? I mean, everybody's talking about Gong as a great proxy for Hutchison, the fact that they actually get paid to hold the property assets of Li Ka-shing. Sun Hung Kai Properties, what about that one? I mean, they lost all their sexiness when they spun off Sunny Vision, didn't they?
No, I think the two big property companies in Hong Kong are both Kong and Sun Hung Kai Properties. Those are the two key stocks. These two stocks, if you look over the last 20 years, these stocks have given you massive outperformance over that period. Even with the current recession, they have given you 160 to 200% outperformance of the Hong Kong market. They have delivered consistently over that period excellent shareholder value. Both of these companies are extremely well managed. They have extremely good balance sheets, extremely good strategic directions. I would put my money in either of those two companies in any sense that we're going to see an easing of interest rates. They would be my first two picks. Beyond that, I would look at Henderson Land. Again, the stock is very cheap right now, trading at about a 40% discount to its net asset value. So 3 good stocks there if we start to think that interest rates are going to back off.
Okay, Peter, a lot more to talk about with you. We're going to go for a quick break, though. Peter Churchhouse, Morgan Stanley, Dean Witter. We will return to our conversation with him in just a couple of minutes. Welcome back. You're watching Squawk Box on CNBC Asia. Let's go back to Peter Churchhouse, the Managing Director of Morgan Stanley, Dean Witter in Hong Kong. Peter, before we went to break, we were talking about some of your stock picks in Hong Kong, some of the sectors that you like, particularly in the property sector. Yesterday, we did see a number of the NASDAQ-listed companies being able to trade on the Hong Kong Stock Exchange. Do you think that move makes a difference to investors? Do they really gain more access to some of these stocks that they can otherwise?
I think it does make a difference in Hong Kong and China and the local markets in the region to access these stocks in their own time zone. I think it's probably early days to believe how strong the interest is going to be in these stocks from the local retail market, but I suspect it will pick up over time. I think the other aspect of this, of course, is it does allow US or European institutions to trade these stocks outside of their own time zones. If something happens overnight, late-breaking news and so on in the US, they can perhaps exploit arbitrage opportunities which may exist. So I think it will be a bit of a slow start, but I think it'll build up over time. These are huge stocks. They are some of the biggest that we'll ever see in this market, that's for sure.
We didn't see much retail interest. I mean, we're talking hundreds of Hong Kong dollars per counter here in a market where the moms and pops, the Mr. and Mrs. Wongs of the world are used to penny stocks. Certainly it's a bit too rich for their pickings, isn't it?
Well, you say that, but in actual fact, the board lots to actually access these stocks aren't that high. They're 4,000 or 5,000 Hong Kong dollars, so you can access them reasonably with reasonably small amounts of money. But I think it'll take a little time for the retail investor here to become used to trading these stocks in these markets. We think about them, for example, the 7 stocks that are listed here trades nearly 7 or 8 times as much per day in the US as the entire Hong Kong stock market. So these are huge stocks relative to the local markets for sure.
Some of the cyclicals, the utilities and the traditional safe haven plays are also on your buy list. China Light and Power, CLP Holdings, Hong Kong Gas, Town Gas, for instance. What is so sexy about these companies? I know that some of them have some .com ambitions. I mean, they're actually interested in using their pipes as conduits for fiber opticity in the future or something like that. But that's certainly a venture or a pursuit that's going to be years down the road.
Absolutely, that's right. And I think companies like China Light and Power and Hong Kong Gas have initiatives in these areas. However, quite frankly, at this point, I'm not sure that these stocks have a lot of sex appeal because of their .com aspirations. I think it's really a defensive play right now. As interest rates rise, you typically find these stocks will outperform the overall index in any period of interest rate upside. So I think that's what's attracting people to these stocks, and at the moment they are outperforming in a relative sense against the rest of the market, as the markets come down from over 18,000 back to around the 14,000, 13,000 sort of level. These stocks have outperformed. The other sector that has outperformed very strongly are the property investment companies, these companies that own a lot of office space and retail space in Hong Kong. This sector of the market is really going gangbusters right now, and these companies are doing very well. Companies such as Swire Pacific, Hong Kong Land, Great Eagle, Amoy Properties really have outperformed very strongly in the last couple of months.
In our final minute with you, talk to us about some of the internet stocks. I mean, the likes of PCCW and the Tom.coms. Do you have any exposure to those?
Well, I'm actually restricted on some of these names at the moment because of business that we're involved with. But generally speaking, the .com stocks in Hong Kong are a relatively small number of them. I think this is a fairly new phenomenon in this market, and I think it's going to take a year or two before we really start to see earnings coming through in these companies. But what is fascinating is the fact that many of the major corporates in Hong Kong, the conglomerates, have really taken into this area of development with great gusto and applying a great deal of capital, a great deal of expertise. They're buying in expertise. They're forming joint ventures with the leaders in these businesses out of North America. I think some of these companies really are likely to prove the partners of choice for the .coms coming out of the U.S. And I look at companies such as Chung Kong, Hutchison, PCW, Sun and Kai Properties as being potential partners of choice of the big giants in this business coming out of the States. So I think there's a lot of excitement coming through in this area over the course of the next 2 or 3 years, and particularly with access to China opening up and WTO, I think there's a lot of possibilities here.
Okay, fair enough. Peter Churchhouse, thanks for joining us today. Peter Churchhouse is the Managing Director, Morgan Stanley Dean Witter in Hong Kong.